Well, our next guest just happens to be Matt Curfman from Richmond Brothers. Matt is president and co-owner. Good afternoon.
Hi, Bart. Thanks for having me.
It's a nice neighbor.
It is a very nice neighborhood, and I can attest that that is a wonderful house. And your guest later today, Aaron Dimmick, also recently moved into the neighborhood.
So you have a great neighborhood.
At least a few great neighbors that I know of.
Yeah. All right, well, how's Richmond Brothers doing through the crisis?
Richmond Brothers is doing well and trying to follow all of the stay-at-home orders wherever possible. And, we have one or two people that will be out at our physical office at the airport. It's tough because we have such a beautiful, newer building and we all have to work from home right now. But we're getting through and anxious to see what happens come May 28th and into the summer, as I'm sure everyone else is.
Well, that's it. So much of the future has a big question mark hanging over it. So are there things that people can do to make that question mark a little less questiony?
Less uncertain? Sure. So as Karen and I were emailing to get ready for what are some topics that we could maybe put some value out and help people, I just couldn't stop but thinking about, and I think your guest yesterday, Joe Parker, went through the supply chain of toilet paper. And so why can't we get toilet paper? And it's because that's society's way of trying to have control over something when we really can't control anything. So I thought about what is the opposite of that, is how can someone in their financial world, especially those that have saved for their whole life and are right at that edge of retirement or about to retire or even just retired, or have been for years, what are some things that they could do in their financial world to try to take back some of that control? And so we came up with 4 topics that I thought we would just touch on today.
All right.
And we can kind of go through. So the first chart you see on the screen, I find this rather comical, but it says how not to deal with a scary market. And so imagine that roller coaster is the market. Emotionally, that first green arrow is where most people want to sell after the cliff has already fallen. Take control, they want to grab their toilet paper and go to cash. But that's really the worst time to do it, and they wait until they feel better, which might be right now because the market's come up from its bottom like we're watching on this chart, and that's when they start to buy in. Well, obviously what you see there is sell low and buy high, and that's the opposite of what notorious investors like Warren Buffett suggest. But that's emotionally how people deal with money. So on the other side of that, we might say, hey, as it's come back up, maybe we're at that second point right now, but we would put a big word of caution out because I think we're all seeing the unemployment numbers skyrocket. I think we're unsure of what reopening the economy means. And it's possible that unemployment numbers exceed that of the Great Depression. And no one knows what that's going to mean for the markets, but I would suggest that with the market coming off its bottom, there might be a few things that people could look at right now. And so that kind of set the stage for emotionally how people deal. Now we want to talk about logically how people can take some action steps and gain some control and clarity back in their finances.
Better to make decisions based on logic than emotion.
Always. So whether it's with Richmond Brothers or whomever your financial advisor is, any of your viewers, that's really our job, is to help remove the emotion and help you make conscious and logic decisions that fit into your overall plan. So as I think about this, one of the things that gets lost in all of this is the first step that someone can take. I put determine your continued risk. What I mean by that is a lot of people will come in and they tell us, we ask them about their portfolio and they show statements. And one of the questions we ask is, what is your downside threshold? So for easy math, if someone had $1 million, what's the lowest you're comfortable seeing that $1 million drop to? Not that we like it dropping at all, but what can you tolerate? And if someone says, I don't want to see it go below 900 grand, that's a risk threshold across the whole portfolio. Well, that same person could have 100% of their money in stock, and they're told they're diversified, which is not untrue, but they're diversified within a pool of stocks. That's still one asset class, and if the market drops 37% like it did from February 19th to March 23rd, $1 million would have dropped 370 grand in 1 month.
Wow.
So that's what we mean by continued risk. So just go back in and say how much of your pie chart of your portfolio is actually at market risk, and this may be a good opportunity to potentially skim out of that because we're coming back up that hill now. And that's really where you want to at least look at that. It doesn't mean you have to sell. It doesn't mean you have to act. But understand if things tip back down, How much more are you willing to accept? And so that's really the first thing. And most of us don't understand that concept, or we say the word risk, and we don't know how to quantify it. So one of the things we do with clients is there are reports that we can do with a few simple questions that remove all of the emotion. And it's very logical. If you have $1 million, what's the threshold you don't want to see it go below? And there's standard deviations and statistics that we can solve to say, let's create a portfolio that is your threshold. Mm-hmm. So you just know that's the expectation. So those are reports. Riskalyze reports is a tool, and there's several different tools out there. But it's as simple as you can see on your screen. There's a number 61. It looks like a speed limit sign on the top right. Mm-hmm. You know, the range is 1 to 99. And a 1 is I have all my money in the bank, CDs, money markets, really safe. It doesn't move, but it never earns. And 99 is ultra aggressive, individual, small cap stocks. Mm-hmm. And so there's no right or wrong answer to this. In fact, I have a female client who's single and she's 89. And her risk tolerance for her whole portfolio is over 80. So she's willing to accept a lot of volatility. And she just said, Matt, I've been invested for so long. I've seen so many things. Usually things work out, but she's lucky that she doesn't need her portfolio to live on. So she doesn't take disbursements from it. Mm-hmm. If you're in retirement and you need a portfolio to live on, it's really hard to follow that roller coaster.
How about when we see what this pandemic is doing to the value of companies? Some great examples would be Uber, mm-hmm. Grubhub. Suddenly these companies go from, in the case of Uber, from flying high to almost crash and burn. Grubhub, they can't even keep up, but they're losing tons of money. They're not making money, but their stock has increased. And pandemic-related stock changes. Mm-hmm. Is it too flash in the pan to put any kind of investment or decision making on companies that their fortunes turn on the pandemic?
So that's a really good question. And so when you think about just high level, the market overall, and by market, people think of the Dow Jones, the S&P 500, the NASDAQ. So for example, the NASDAQ is eerily high right now, and the Dow Jones is really low. Mm-hmm. So even as of yesterday, the Dow Jones is still negative 14% year to date. It was down more than 30%.
And it amazes everyone. People just wonder why the stocks have not...
It seems to be disconnected from the reality of life that we're all living. And to your question, companies are rising and falling. And so one of the other points that I think we can tie into that question, as stock prices or the market ebb and flow and that volatility persists, if you have retirement accounts, there is a way that you can minimize your future taxes. And I want to emphasize future. And the reason I say future is, before this pandemic started, our government had a $24 trillion deficit. And then in March 27th was the CARES Act that passed, multiple trillions of dollars more. Now it may work out well, but it's too soon to tell. Yeah. And it's more likely than not that our deficit balloons even further. So what would we all think that means down the road for taxes?
Higher taxes.
I would suggest it means higher taxes. And so if you had a retirement account such as a 401k, a 403b, a pension rollover, an IRA that you haven't paid tax on yet, and let's just stick with $1 million because that's easy math in my head. If you had $1 million in an IRA and you hit 72 and now you're required to take money out of it, if that's 5 or 10 years from now, and you and I both agree, I'm sure many reviewers do, that taxes could go a lot higher. I don't want to pay tax at future rates. I know the tax rates are really low now. And if I think they're going to go up, I may want to move some of my IRA money over to a Roth IRA. Choose to pay some tax now to minimize that future tax. Does that make sense?
Absolutely.
And so that's another thing we're doing with a lot of clients. And I would actually tell you that through the last month and a half, on a case-by-case basis, dollar by dollar, we've converted in excess of $3 million. And it's $1,000 at a time. I've had clients that have done $100,000. But, I kind of think about back to when I was a kid. I think it was called a slinky dinky, those things you'd set on the stairs and it just goes down. So imagine your slinky is stretched all the way out, and that's when the market was high, and you had a $100,000 investment. Well, if you were going to hold stocks and you were going to ride through, now the pandemic hits, and let's say it dropped 30%, so now your slinky is shrinking, 100 grand's worth 70. Well, do you consider taking that 70 grand and converting it into the Roth and you're going to pay less tax and then let it recover in a Roth that down the road is tax-free to you and tax-free to your family, and it passes income tax-free to your heirs. So actually the choppiness within your portfolio, if you have retirement accounts, creates opportunistic environments to take advantage of this strategy. And everyone who has an IRA or any retirement account is eligible to do a Roth conversion. It doesn't matter if your income, it doesn't matter the size of your IRA. Everyone who has that type of account is eligible no matter what. We are choosing to pay tax now, but I think we'd all agree, I did a study looking back at the tax rates for the last 100 years. These are actually, other than the first 2 years the tax code was introduced, these are the lowest tax rates we've had in 100 years.
Right now.
So another reason to try to take advantage. And as those values come down, you pay less tax on the same shares.
Well, I think everybody will agree that taxes are not going to be coming down.
Doesn't seem like that could be a
No.
logical thing to happen if you fast forward. And I don't, that's not a political statement, and I don't think it matters who's in the White House come the fall.
No.
Eventually, we are going to acknowledge that we have a massive deficit. No matter how strong the economy is, we're not growing out of it, and it keeps getting higher. If you think about that on a personal level, I mean, even in the business, it's like every single year, if you and Karen in the business just took on an extra 200 grand of debt for 20 years and said, we'll figure it out in 40 years. It's not logical, and it's laughable,
Right.
but that's really what's happening.
And even on a state level, I mean, those are the kinds of things we can see and really, we can grasp that.
Yeah.
We don't have the money we didn't have the money for the roads last year. Well, we definitely don't have the money for the roads this year.
Yep, it's affecting everyone and everything.
All right, so you've got, your recommendation is to get a written retirement plan. What do
Yep.
you mean by that?
So two things. One quick step back on that,
Okay.
if I have just a minute, but ensure your foundation is solid. So if you've ever built a house, you wouldn't just go throw the house up on the grass and on the sand. You'd build a foundation first. So anything about your portfolio, what is your foundation? So everything probably shouldn't be invested in stocks. Depends on your risk tolerance, but what can you buy that are foundational assets? And that could include money markets, CDs. It could include a fixed indexed annuity. And those are just pieces that could complement and be safety nets in your portfolio or foundations. So I just think it's a good opportunity for people to consider those things. And that's not a product specific recommendation, but sometimes we hear a word and we're afraid of it because we've heard bad things, or people don't like the word taxes, but here I am telling you, you should pay more tax now. So maybe we should go outside of our own mindset and get more educated on the topics. And sometimes you just don't know what you don't know. And you need someone to present it to you. And there's a lot of things I don't know. That's why you bring professionals around that can help me ask questions. So that foundation is important. And then lastly, the written retirement income plan. So imagine this, you're working for 30 or 40 years. Karen just told me on the way in that you guys have your 40th wedding anniversary this year. I imagine a lot of those years you've been working.
I think pretty much.
And,
Yeah.
and as an entrepreneur, you're creating your own paychecks, right? If you work for Consumers Energy or Henry Ford or any other business, while we're working, we pretty much know that we're going to get our paycheck as long as we do a good job and we get along with others and we perform well. We're going to get our paycheck once a month, every 2 weeks. We know where it's coming from. We know who's writing it to us. We know the date that it gets deposited. And if something changes or we lose our job, we have to go find a new job. And then we know where it's coming from. But in retirement, we lose sight of that simple fact. So a written retirement income plan just says, okay, Matt, if I retire and I'm 60, where is my paycheck coming from for the next year? I can't get Social Security yet, so do I use the portfolio? Do I have to work part-time? Do I have a fixed income annuity? Do I have a pension? Am I going to work part-time? All these pieces, and you can literally lay this out in a spreadsheet, and the client, anyone can know, okay, what is the plan? Where's my paycheck coming from? And when you can bring that calmness to all of the chaos in the markets and the investment world, we have spent all of our time with clients reinforming them of the plans we already had laid in place.
I like that word, reinforming.
Reinforming, because it's our world and we live in it, and clients hire us to help address these questions. So these are really simple concepts, but these are ways, other than buying up all the toilet paper that you see in the store, that financially we can get some sense of control and logic back in our financial lives.
Great and easy to understand information today, Matt.
Thank you. I hope so.
Yeah. Thanks for being here today.
Thank you for having me, and thanks for being a good resource in the community.
Well, thanks. You can reach Matt at Richmond Brothers, giving them a call or visiting their website. And I suggest you see all the resources that they have right online. Thanks, Matt.
Thanks, Bart.
From Richmond Brothers, co-owner and president Matt Curfman. Up next here on the show, we